The government just handed SMSF owners a massive permanent tax advantage over every other investor in Australia. If you own property or shares outside of super, the new budget just killed your 50% capital gains tax discount. But there is one legal loophole they explicitly left open. Most investors assume these new tax hikes apply to everyone across the board. They think the days of tax-effective investing are over. But the reality is, the gap between investing in your personal name versus investing inside an SMSF just became a canyon. I'm Troy, founder of Blue Chip SMSF, and we've set up thousands of SMSFs for Aussies. Today, we are breaking down exactly what the 2026 budget means for your wealth. We'll cover the removal of the CGT discount, the new rules for negative gearing and discretionary trusts, and why SMSFs are now the most powerful tax structure in the country. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Let's start with the biggest shockwave from the budget, the removal of the 50% capital gains tax discount. For decades, the rule was simple. Hold an asset for more than 12 months and you only paid tax on half the profit when you sold it. That era is ending. From July 1st, 2027, the government is replacing the 50% discount with cost-based indexation for individuals, trusts and partnerships. On top of that, they're introducing a 30% minimum tax on real capital gains. Here's what that means in plain terms. If you sell an investment property or shares in your own name, your tax bill is going up, in many cases significantly. We're effectively going back to a pre-1999 system where gains are adjusted for inflation instead of receiving a flat discount. But here's the part most people are missing. Superannuation funds, including SMSFs, are not being touched by these changes. While individual investors lose the 50% discount, SMSFs keep their existing 1/3 discount on assets held longer than 12 months. That's straight from the budget papers, so the gap just widened. Holding growth assets inside an SMSF is now far more tax efficient than holding them in your personal name. Now, let's look at negative gearing. Right now, the rule is straightforward. If your investment property costs more to hold than it brings in, you can offset that loss against your other income, like your salary. That's about to change. From July 1st, 2027, negative gearing will be restricted to newly built properties only. If you buy an existing property after the cutoff, you won't be able to use those losses to reduce your salary income. Instead, those losses are quarantined. That means they can only be used against other property income or future capital gains. There is a carve-out. If you purchased a property before 7:30 p.m. on May 12th, 2026, you're grandfathered in until you sell. But again, look at where the line is drawn. Superannuation funds, including SMSFs, are excluded from these restrictions. Now, in practice, this matters less inside super. SMSFs don't typically offset losses against personal income anyway. But the pattern is clear. Personal investors are being tightened, superannuation is being left alone. And every change like this widens the gap between the two. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes and let's build your future on your terms. Now, back to the episode. Finally, the budget targeted discretionary trusts, often called family trusts. From July 1st, 2028, the government is introducing a 30% minimum tax on distributions from discretionary trusts. This tax is applied directly at the trustee level. For years, business owners and investors have used these structures to distribute income to family members on lower tax rates or to corporate beneficiaries, often called bucket companies, which are capped at a 25% tax rate. That strategy is now under pressure. This new 30% minimum tax effectively shuts down the bucket company approach because corporate beneficiaries won't receive non-refundable credits for the tax already paid by the trustee. The result is simple. Family trusts become far less tax efficient, especially for small to medium business owners. But once again, look at the exemption. Complying superannuation funds are not included in this change. Now zoom out. You've got three major shifts happening at once: the removal of the capital gains tax discount, the restriction of negative gearing, and a new 30% tax on discretionary trusts. Put them together and the direction is obvious. The government is steadily removing the tax advantages of investing in your personal name or through a family trust. At the same time, they've made a deliberate choice to leave superannuation concessions untouched. This changes the equation completely. The difference between investing in your own name and investing through an SMSF is no longer marginal. It's massive. What used to be a gap is now a canyon. If you've been sitting on the fence about setting up an SMSF to invest in property or shares, this shifts the decision. The structure is now clearly one of the most tax-effective options available in Australia under the current rules. If you're considering setting up an SMSF, now is the time to explore it properly. Reach out to the team at Blue Chip SMSF and see if it's the right fit for your situation.
Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.